Hey, it's Ryan. Don't pay cash for a home. Let me show you some of the numbers and how this pencils out and why you might want to take a look at other options than just paying cash for the house. So let's run some numbers real quick. So we're going to use a purchase price of 450,000. So that's just going to be our base number that we're going to use for 450,000. Let's say you put half money down. Let's just say you put 50% down. That would be a loan amount of 225,000. Now, obviously, you're going to have some closing costs, some loan fees. So let's just take 3% of the loan amount. Usually they can be higher or lower depending on the rate you choose, credit scores, a lot of different factors. But just for the sake of this illustration, let's just say it's 3% of the balance, which is 6750. Now, this isn't all loan costs. This can be the escrow account, homeowner's insurance. Again, I'm just going to use that number to show you how these numbers pencil out. So in 225,000 minus 6750. So now you have $218,250 left over. Okay. So what's the payment at 225,000? Let's use 6% as an interest rate. Interest rates can be higher or lower depending on your credit score, buy downs, loan to values. There's a couple of different things that factor into credit score. But again, just for the sake of this illustration, let's say it's 6%. So the payment on that amount would be $1,348.99 per month. Here's where it gets pretty crazy. Let's say you take the savings of the 218,000, put it into an account and have it draft to make the mortgage payment. How long would the money last? It would last 161.78 months or 13.48 years. That's not counting any interest being earned on the 218,000 over the course that it's sitting in the account. So that's something to consider, that how long would it be before you actually have a mortgage payment? It's either give them all the money right now or spread it out over time and you earn the rate of return on that money and not have a mortgage payment for at least that long. Now, many people don't stay in the home that long, or maybe they need to downgrade and upgrade, but having access to the money might be better than just having it tied up in equity, where the only way you get it back is selling or refinancing the home. It's funny how we have all this diversification in financial planning and estate planning and all these types of things, where you wouldn't take all 450,000 and buy one stock with it or one gold bar with it, but we do it with real estate all the time when you can leverage it with way better interest rates than anything else that's out there. So I wanted to run those numbers for you and say, would it be better to have 200,000 in the bank earning interest or 200,000 in equity you can't even get to? And equity doesn't go up or down based on what you owe on the property. So it's not like owing less on it makes it worth more or less. It doesn't really change what its value is. Let me run some numbers on putting 5% down. Let's use the same 450,000, but now the loan is 427,500. Now the payment is $2,563.08. But you're going to have more loan fees because the loan amount is going to be higher, and you can use money to buy out the mortgage insurance to make the payment as low as possible. So in this scenario, let's say there's $39,800, $500 in loan fees, mortgage buyout, the whole thing, down payment, the whole thing. So let's say that's that much total down. Okay, so now let's do some quick math. That shows that now we have $410,500 left over. Okay, so how many months will that last for? You know, the crazy thing is it'll actually last for 160.16 months or 13.34 years. So it is a little bit less, but now you've got $410,000 earning interest being diversified, layered in other investments versus only having the 218,000. So now you have about the same amount of time that before the money runs out, but now you're earning more as potential interest over the next 5, 10, 13 years of being able to push that payment off even further. So either way, they're going to get the money. Whether they get it all today or spreading it out, sometimes that can give you better financial security, pay off other debts, have no mortgage payment for that particular time, and you have access to it if you really need to, where you may not have access to the equity as quickly without having to sell or refinance the home. Who knows where the rates are going to be when you need to sell or refinance? The other thing I've seen people do is they can qualify for a loan easier today than they will be able to in 10 years if they retire or lose income or spouse passes away. A lot of things can change during the course of that loan. So your qualifications, interest rates are probably better now than they will be in the future when you actually need the money or need the equity or that type of thing. So these are things to consider. I don't think it's worth putting all the money down on a home when the rates are still, even at 6%, the numbers don't pencil out. When you'll be able to get that rate of return or better, or more importantly, even if you don't get a 6% rate of return, having the cash flow, having access to the money, having that interest rate offset by the savings, and you were just going to give them all the money right when you were going to buy the home anyway. This is just spreading it out. And while you spread it out, you earn the rate of return on it and you have additional security. So I'd love to talk to you about how these numbers work for you, whether it's the magic number of 5% down, 50% down, or somewhere in between. But you really should take a look at leveraging the mortgage loan to keep your money liquid, to reinvest, to earn other rates of return, especially over the course of the next 10 years. So I'd love to talk to you about it. Check out my website at ryanbolton.com, where you can call and schedule an appointment or show you anything we're able to do. We do loan in the state of Utah and Nevada. So give me a call if you have any questions or check out my website at ryanbolton.com. Hope you're having a wonderful day.